In a weird turn of events, the job market went from pandemic layoffs in 2020 to the Great Resignation in 2021 to quiet quitting in 2022 to what it looks like layoffs again in 2023. The reason why I'm saying it's a weird turn of events is because right now in today's job market, we have workers who are struggling to get and keep jobs. Then you have the Federal Reserve Bank who's saying that the job market is essentially better than ever. And then you have Wall Street that's hoping for a weak jobs report. Wall Street is in the business of making money, so you'd think that they'd want a strong jobs number because that means that companies are thriving and making big profits, right? Wrong. See, Wall Street doesn't care about corporate profits the way most people think that they do, at least in this economy, because the thing that's more important than corporate profits to Wall Street is stock prices. If a company isn't profitable, but its stock price is soaring, well, Wall Street investors will take that stock profit all day long. You'll see why this is so important a little bit later in this video. So if Wall Street cares about stock prices, you have to understand the three things that influence stock prices. It's the health of the company, aka profits, it's the health of the economy, and it's the availability of money. Generally, Wall Street would love to see everybody have jobs because that means companies are thriving, they're able to sell products and make big profits, which is good for stock prices. But in today's economy, where inflation is hot and the fight on inflation is even hotter, this is where investors are looking at things a little bit differently. Inflation happens when you have too much money in the economic system. So the fight on inflation is when you're literally pulling money out of the economic system. Now, if you remember what I said just a second ago, there's three things that impact stock prices: the health of the company, the health of the economy, and the availability of money. If you're fighting inflation, aka pulling money out of the economy, well, now the availability of money is dropping, which is not good news for stock prices. The Federal Reserve Bank is fighting inflation by raising interest rates and by selling off their balance sheet as a way to make money less available. And this is why the Federal Reserve Bank is saying that the labor market is too tight. And according to them, if people lose their jobs, it would be a byproduct of bringing inflation down. This is why Wall Street is saying, let's get this over with. Let's get the job losses here. That way we can then start cutting interest rates. That way we can then start boosting the stock market again. Except it's not so easy this time. You're also seeing a big shift in the labor market. Take a look at this chart by the Bureau of Labor Statistics. This shows you the number of unemployed people per job opening, and in 2022, it's the lowest ever. And the latest numbers show us that 0.6 unemployed people are out there per job opening. That means, again, according to what the data says, that there's almost 2 job openings out there for every 1 person who's looking for a job. So where's this discrepancy happening? Well, some people are having to work 2 jobs just to be able to afford the higher cost of living. Some people just don't like the jobs that are out there or the pay that these jobs are offering. And then some people have turned to entrepreneurship or creating a side hustle as a way to make ends meet rather than a traditional job. Now, for my entrepreneur and business owner viewers, I do have some good news for you because today we officially launched Business Briefs, which is my business newsletter catered towards entrepreneurs, founders, CEOs, and business owners. This is a completely free newsletter that keeps you up to date on what's happening in the business economy. These are things from what's happening in the innovation side of the world, what's happening in terms of business funding, and what's happening in business trends. My team is doing this research every single day. This way you can be more well informed so you can make better decisions with your money in your business. Business Briefs is completely free. So if you'd like to join Business Briefs, I got the link to how you can join Business Briefs for free down in the description below. It's pretty clear that higher interest rates affect the economy, but the question is, to what extent will it affect the economy? I mean, higher interest rates make it more expensive to borrow money, and it makes the cost of servicing the debt that you already have more expensive unless you have something like a 30-year fixed rate mortgage. But if you're a business owner, you don't have 30-year fixed rate mortgages. You have short-term loans that expire every few years. The reason why this is having such a significant impact on our economy today is because over the last decade or so, businesses and people have become so reliant on extremely low interest rates, and now in 2022, we've been rapidly increasing interest rates, changing the entire economic environment that we're in, which is affecting companies that have been reliant on these low interest rates. A new report that came out in the end of October in 2022 said that zombie companies around the world have grown by 10% in just the last year. Now, there's a lot of different technical definitions of what a zombie company is, but in its most general terms, a zombie company is a company that's not making enough money to even cover their debt payments. Here in the United States, there's estimated to be about 200 different zombie companies that are publicly traded on our stock market today. This is where you can really start to see all the different economic factors coming together. Because on one hand, we have really high inflation. Now, in order to fight inflation, the Federal Reserve Bank is raising interest rates. These rising interest rates hurt businesses because now the cost of borrowing money becomes more expensive and the cost of servicing your debt becomes more expensive. Then we have all these companies that have been reliant on super low interest rates for the last decade and a half. Now, these companies who have been relying on super low interest rates are having to borrow money at higher interest rates. And then you have companies that don't have enough money to service these higher debts, which mean that they're going to have to cut their costs. That means some of these companies are going to have to start laying off employees. The more employees you lay off, the more the economy struggles. The more the economy struggles, well, then the more the economy struggles even more, because when the economy struggles, someone loses their job, they don't have the ability to make their car payment, they don't have the ability to make their mortgage payment, which then creates a deeper spiral for a downward cycle in the economy. And this is the trouble that the Federal Reserve Bank is facing because they need to raise interest rates to fight inflation, but at the same time, they're worried about pushing the economy into a deep recession. But right now, as of today, now again, this can change, but today, their goal is to bring inflation down, even if that means causing job layoffs and even if that means causing a recession, because if you don't bring the inflation problem under control, well, then you risk something like a currency crisis, and that could be a much bigger problem to deal with than dealing with a recession. This is where you want to be doing one of two things. One, you need to be managing your money better, whether or not you own a business. Now, if you own a business, Business Briefs can help you with that. It's a free resource. And if you don't own a business, this is where you want to be putting some cash aside. That way you have cash to take advantage of opportunities that might come your way. And second, you have to be financially educated. That way you know how to capitalize on opportunities that might come your way, because these types of economic slowdowns create volatile markets, which means they create opportunities for you to come in and buy some assets at a discounted price. And you don't want to miss this opportunity, because these are opportunities that can allow you to accelerate your path to wealth. People spend too much money, people get greedy, businesses get greedy, businesses spend too much money, and this is where now you need a correction, where now you're spending more money to pay down your debt instead of actually buying more stuff. Now, instead of going to Chipotle to buy extra guac, you're eating at home. That way you can pay back your credit card debt for all the extra guac that you ate.